All right, we are back. Welcome back, chat. We are live. Things are getting spicy out there. Things are getting spicy. We got markets selling off. Just as we were anticipating, we're going to discuss the market pullback tonight. And what else do we got on the docket? One of the things that I've been building out is this tax flow idea. We tried to code in real time during the stream the other night. Didn't work out all that well. It was a little more distracting than I thought it was going to be to code and stream at the same time. But I have the tax stuff to discuss. It's what I want in terms of kind of what I had in mind when I set out. So we'll go over that, and we'll also go over in detail kind of how I built it up and the things I had to figure out along the way, which I think was probably the more instructive part of the part that people did want to see, but I don't think that I was really able to get across. So I'll go through the thought process in that. I also have some, I saw, I think at the end of last stream, I think it was pointed out that Bob Murphy had tweeted out kind of a challenge to Stephanie Kelton regarding rates and regarding inflation, and I've done some work on that to try and show at least how you would approach such a topic, and then like do some statistics and math to try and get on the right track in terms of when you kind of see correlation. So we have a lot I want to cover tonight. A couple other things I'll hit on as well, but like I said, we'll get kick it off here soon in just a second, talking about the Ghost on the Half Shell. Why would I have a smirk on my face? It's not like I've been calling for an imminent sell-off in stocks for the past week or two, and it's not like all of a sudden we're seeing an imminent sell-off in stocks. Let's see. Getting an error on the stream. Are you guys noticing any issues? I don't even think I can. I suppose you are way above. Yeah, I'm way above that. I've never once patted myself on the back before. Always. Yeah. All right. It's unfortunately saying it told me to start using ultra low latency. And then it also said don't use 1440p, and then I subsequently used ultra low latency, and I'm realizing that I had my stream set at 1440p. Video smooth as a baby's bottom. All right, well, we're just gonna go ahead and let it run. I also need to hit live on the. Give me 1 second. I want to hit live on the Twitter stream as well. Anyway, how you doing tonight, chat? We have a lot to cover. Gonna have a lot of fun tonight. Gonna debunk some Austrian nonsense. I'll probably cut that part out, and hopefully, God, the Twitter, the Twitter tool for streaming is just terrible. Sometimes I think the YouTube tool could be better, but the Twitter tool is particularly difficult to deal with. All right, well, we're just going to have to deal with the error on the stream. Anyway, let's see. What we're going to discuss first. I think I wanted to chat the market sell-off. I also tweeted out about deep MMT as well. We can kind of talk that. I had some good questions regarding deep MMT, so I think I want to get into and kind of dive into that topic as well, and kind of give some more context to what deep MMT is doing and kind of where I plan on going next with deep MMT. So that'll be on the docket tonight as well. Anyway, we are seeing markets sell off, and look, I can't I can't think of a better kind of better proof, better just recognition of what MMT is all about than just understanding what the core flow is and then how markets respond to that. So often I'll tweet this stuff out, and I just everyone, the response is effectively, well, yeah, duh, if the government prints money, that's going to inflate asset prices and whatnot. And usually the number one response when I'm right, if there's going to be kind of this this pushback against MMT, is like, well, yeah, everyone knows that, and yet no one's making these calls. There's just a handful of us that are making these calls in any substantive way. And if this is so obvious, why isn't everyone doing this? And why is there still so much pushback from MMT? And I also think, too, another thing that's kind of worth pointing out is again, what I'm doing here is simply using MMT as a framework for analysis. And that's really key, kind of kicking things off here. MMT is a framework for analysis. It is the proper and correct framework under our monetary system. And this monetary system that we've had is effectively gone back 5,000 years. Now, granted, there are various times in history where we impose different requirements on banks within the monetary system. There are self-imposed requirements that can change the dynamics, but still, the overall MMT framework for analysis remains regardless of the underlying policy. And so the framework is the framework, and we've always lived in an MMT world. For whatever reason, MMT got this connotation that it's like just aggressive government spending, that's what it means to be MMT or what MMT is. And again, MMT is not that. You can make very left-wing progressive economic arguments that are MMT based, meaning they're using the proper framework for analysis for understanding how the government spends and what the implications of that spending are. And you can make relatively right-wing, small government, conservative sort of proposals as well. And you can have those debates. I think that the most important takeaway, or the first takeaway with what MMT is trying to get across, is that government spending is adding net financial assets to the private sector. I think that is one pillar that is very important, especially if you're an investor or trader, and we'll kind of go over that in just a second as to why that directly correlates with markets. The next part of that, though, is that the currency itself is the tax credit, right? So the government's going to want that back. It's going to drive the use of that currency and then every consequence that flows from there. So I would say, I mean, if there are two of the most important pillars, those are it. Now, from there, other implications get involved, right? So a good example of this would be if a country decides to not tax in its own currency. Zimbabwe comes to mind in that, right? So it's not using its own currency as a tax credit. Then the currency that it is issuing is going to have very little value, right? I believe Zimbabwe allows dollar deposits or dollars as tax credits. And so the minute you undercut the value as a tax credit of your own currency, you're going to see the actual country's currency diminish in value as well. We've talked many times about the whole concept of not issuing debt in another currency other than your own, and all that sort of stuff. And so those are consequences of the whole idea that your currency is a tax credit. But going back to the first point, that when the government spends, that's adding net financial assets to the private sector. This is the core concept of the entire AppliedMMT approach. And what I mean by AppliedMMT is just simply, how can I use the proper framework for analysis that correctly explains our monetary and fiscal system, which is MMT. And even the detractors have to, I mean, usually they say something to the extent of, yeah, this is true, but I think I even caught Per Byland, my arch nemesis, doing something very similar, or saying something very similar recently. Let me track that down and see if I have Per's tweet. I think I liked it, or I think I bookmarked it when it happened. Yeah. Ugh. Twitter's falling apart here. I did bookmark it, so let me pull it up in just a second. And even Per, Doug, you get everything wrong, and MMT is wrong. Admitted, yes, it works relative to MMT as a description of current price of monetary policy. The problem is when they claim it's a theory, and worse, a theory of the entire economy. But at the very least, he admitted that the base case being presented is the proper description. Of current monetary policy, and I had to laugh. I tried to goad him into maybe he did respond. No, he never did end up responding. But I tried to goad him into a response, saying like, "Yeah, look, we agree, man, we agree." But then I said, look, besides the job guarantee, the MMT is not making any policy claims per se. It's simply just stating what is just the factual sequence of how spending works in a monetary system. And for the most part, as far as we can tell, we've had monetary systems for the majority of written human civilization. But I wanted to kick things off with a discussion of where prices at and what's happening in markets. Handful of people jumping in chat. I'll say hi real quick. We got Ghost on the Half Shell, Vladimir, welcome. Bully Popet, welcome. Netty, thanks for dropping in. And if anyone else is in here, make sure you say hi. And if you're watching this on Twitter, make sure you jump on over. If you want to engage in chat, obviously, if you don't care to engage in chat, that's fine. But if you want to engage in chat, make sure you jump on over to YouTube. Is this even playing? Twitter's so broke right now. It's not even, the tweet's not even playing. That's so dumb. Whatever. All right. On to markets. So we had been calling for a bit of a top here as of late. Oh yeah, Jesus also welcome in chat. And Echo Skeleton, welcome as well. We've been calling for a top recently in markets, and it really coincides with what we've been seeing in flows. And I think we've been over this for the past few weeks, but we're really starting to see, and I'm going to pull this up on our data dashboard over at AppliedMMT.com, that we're really starting to see the bulk of that tax drain hit as we approach tax day, which is today. If you don't have your taxes paid, make sure you get those paid. But already 57 billion drain on Friday, 14 on what would that have been, Thursday. And we did have a bit of a boost on Wednesday, but we're starting to see those tax drains really hit the private sector. And of course, we're going to have a massive drain come tomorrow when we finally get the print. I am a little curious. 2023, what do we have? April 15th. So the big drain would have been hitting on the 18th is when it would have been reported. So between the 17th and 18th, did we get a delay in taxes? Were taxes due the 18th last year? We had 116 billion on what I'll call the peak for the tax drain. What I'm really curious about, and just remember, 2022 was a massively bearish year. So whatever day that was, okay, so we had about the same amount, a little bit more in 2022. So you can see for comparison, but we are getting very, very close to that peak drain period. And just depending on what the liquidity drain is during that time period is really what the long-term effects are going to be of markets. And we're starting to see that hit. And again, I think I talked about this during the last stream, but generally speaking, moving up into this point, we actually get kind of a hold on markets. They almost sideways into the end of April, and then May is really where the drain begins. And I think the risk here is and was that we just seen such a strong rise to this point, and we were just from a pure momentum standpoint really starting to wane in terms of momentum. And so that's why I think we're seeing kind of the bearishness kick in a little bit early. Overall, too, and I'm sure this will come up, overall, too, I don't think ultimately the action that's happening right now between Iran and Israel is really any driver in the selling that we're seeing in markets. I think we would have played out exactly today as we would have otherwise had the activities that took place over the weekend not taken place. Again, obviously, there are global geopolitical implications of what's taking place in Israel and in Palestine right now. But when it comes to implications on the market, this is just too small for a concern for markets here. And it doesn't really look like there's a real desire for the U.S. to ramp up spending in any meaningful way. Certainly not like they did with Ukraine. And so I think the implications here are going to be relatively muted in terms of the spending implications. Certainly the long term, though, I mean, the more saber rattling there is, the more military activity there is globally, the better that is for markets longer term, because it does elicit more military spending, and then of course is adding those net financial assets. And again, like I said at the outset, this isn't necessarily a commentary on the merits of military activity or not. It's a commentary on the consequence of what the spending does to asset prices and in the longer term trajectory of assets because of that. So yeah, just a way to kind of, I mean, I think the best way to put it is you need to compartmentalize. If you're an investor and a trader, right, you need to compartmentalize the reality of what is driving markets versus the reality of what's happening in a geopolitical, on the geopolitical landscape. Now, sometimes, like we saw with Russia invading Ukraine, there is an immediate implication there, right? And certainly, not only was there immediate implication, there was a lot of fear, a lot of unknown, very unprecedented in terms of what was taking place, at least over the last 20, 30 years with something like that. The implications were also much more broad, right? The immediate implication was we just don't know what's going to happen. Oil spikes, supply chains continue to get disrupted because of it. So there were those sort of implications that are far closer to the financial, we'll call it kind of the financial connect the dot to the market, versus what's happening in Israel and Palestine right now is it's just not. I mean, we're just not going to see a disruption in terms of supply chains or anything like that we saw. And in fact, actually, oil was down today, even given that news. And so I think the consensus is Iran telegraphed everything they were going to do to make sure they actually didn't do any real damage, but we're still able to save face, and everyone could say they're a winner in this scenario, and things are just going to kind of blow over at this point. So that's kind of my take on the implications here of what's happening in Israel, Iran, and Palestine right now, and it doesn't look like this is going to bubble over beyond the current situation that we're seeing in Palestine. All right, the next thing I think I wanted to mention was, let's talk DeepMMT and kind of what DeepMMT was seeing. And there were some questions. Regarding DeepMMT on the post today, and I will go back to my own post here as a reference point to discuss. All right. DeepMMT, we did launch it about a year ago. I think it officially launched in May, but I had pretty much everything down and was starting to share the initial idea to subs over at AppliedMMT all the way back in April, and we've been at it for a month now. A year. And so essentially, I mean, the track record really speaks for itself. And in all honesty, the whole idea is that the whole idea with DeepMMT was to build a deep learning model that was a regression model. There are a million models out there that are kind of these buy-sell models that give like a buy-sell signal. And I've never seen a model particularly that is targeted at kind of a regression prediction of markets given various inputs. And some of the things you can do with deep learning models is you can what's the best word to use here? You can kind of inform the deep learning model with various theories, or there are ways you can kind of craft the data, engineer, they say it in the deep learning world, engineer the data that you're going to feed into the model, and then pick particular ways to build the model to understand the data and to learn the dynamics that are happening, right? So you can build these models up to understand the data in a certain way. And so when I say this is an MMT informed deep learning model, it's really what I mean by that. And I just never seen a macro informed learning model in the past. And so DeepMMT was setting out to do that. I've certainly seen a lot of machine learning models that are looking to do run various statistical assessments for trying to understand if an asset is properly priced or how far off what kind of the proper price would be. But this is truly a regression prediction, and is a bit unique in this space. And one of the things I pointed out too is like it's awesome. It's kicked butt, and certainly all the subs over at AppliedMMT are aware of this, and we've been having a ton of fun tracking this thing, and it's been pretty on point. Has it been perfect? No model's ever going to be perfect, but for what it is and what it set out to do, I've been thoroughly overwhelmed by the its ability to really kind of understand the various dynamics. But I think the other really cool part about this, and actually I gave a lecture at a university recently where I was showing off some of the stuff that we've been doing and kind of hopefully scratching the or not scratching the itch, but putting the pebble in the shoe for the next generation of economists and academics for their, how they could what they could pursue in their career, and how you can really take economics to really a whole new frontier here. And one of the things that I pointed out, and really just I get geeked every time it happens, is just the ability for these deep learning models to learn under the constraints of MMT. It is so cool to see these models demonstrate that they're actually learning what we know from theory, right? And I think it is, and later tonight during the stream, I'm going to go over some of the debunking stuff that I'm going to do with what Bob Murphy tweeted, and I'll go through the steps, and you just go through these steps, and you spend the hours to build out these various data tables to understand. These various tables to understand if there's any correlation there, what the kind of causal inference is, what the causal structure is, and then when it all like pans together as you would have expected, and it all just kind of how do I put this? Yeah, I mean it all just it's able to learn and it's able to predict, and you're able to determine that there is in fact learning taking place. Then it is just a thrilling thing to see, and just really helps confirm the overall the overall merits of MMT, and continues to confirm what I've always known, which is just MMT is right, and I'm eager to see if any other schools of thought are able to produce anything similar and publish it and just let it run. And again, I like to publish these every 3 to 6 months, just so they're out there and everyone can see the track record for what it is. So yeah, deep MMT. One of the questions that came up was why is there this massive gap between price and where the prediction is? And one of the things, I can just keep it up on screen. One of the things that deep MMT is doing underneath the hood is it's actually predicting the entirety of price going all the way back to the beginning, which is like 1980. It's predicting the price the entire time during the entire time series. And so what it's saying is along the way, it's just seeing a really a bifurcation between where price is and where it thinks price should be. Now, over time, it knows where price is, and then when I retrain the model, and you can see down here, it says that the data was updated as of this yesterday, and the model was last trained last week. So when I retrain the model, it'll kind of fill the gap back in, but then over time it'll deconverge, if you will, from the underlying price, because it just thinks at this point that price shouldn't be that high. And so this is what we've been seeing for the last few weeks with deep MMT, is this gap between price and where the prediction is, because the implication being that there was going to be a drop there in price. In other words, we're overpriced. The other thing too is it does just drift over time. I do have to train this on a somewhat regular basis, a week or two, every week or two it needs to be trained, because if you don't, you do get this you get this drift between the prediction and the actual price. And the reason for that is the underlying dynamic that it's learning, right? So I like the underlying equation of nature that it's learning is always a moving target. There are always new inputs that are kind of unseen that are shifting the dynamic between what the underlying flows are and how those project then onto your target, which in this case is the S&P. So there is a constant kind of training that needs to take place, and we retrain it so it's always up to date. But that's what that gap is. I hope that's a kind of a good explanation so you can understand what is actually going on. So yeah, that was one of the questions. Another good question that came up is when did it actually predict the top? And if I recall, it was early March, not mid-March. So it's been thinking we're a little bit overpriced for about a couple weeks now, maybe even a month. Yeah, about a month now, in terms of, because I think we hit the actual top on the last day of March, like the first day of April. And then the point here too is, if we go below say 5,000 on the S&P 500, I count it a win for deep MMT. I mean, at that point it was kind of right in anticipating that we were overpriced, and would certainly kind of give us a better positioning when we want to get aggressive once again and kind of reaggress Let's see. Yeah, the last comment too, and this is I mean I'm patting myself on the back here. I understand that, but regardless of your ideology, it's been consistently right, and that's all that matters. And I agree. I mean, to me, and I know some of my detractors, especially those on the Austrian side, want to poo-poo empirics, but I can't make money. I can't make the right call based on theory and rhetoric alone, right? I actually need to understand the dynamics of how markets work, and that's why I was ultimately convinced by MMT, because it was a truly a real scientific approach to markets, an empirical approach to markets that had predictive power. And yeah, you can go down your path of rhetoric and logic and think it's wrong, but at the end of the day, the empirical approach seems to be winning. All right, we'll touch on what do I want to hit on next. I think I want to jump to chat real quick, because I think I saw a few things come up in chat. So let me roll back. I think I saw a specific question. Saul, we have Doug, how is it possible that the Fed, Congress, and Treasury being so backwards for decades, and how debt and effect on rates in the economy there's been so much progress growth in the U.S. economy? That's a good question. So, I mean, the way I'm reading that is, I don't think I have. Give me 1 second. Let me get that overlay set up here, and then we'll... The way I'm reading that question is, if everyone's got it wrong, how can we have seen so much growth over time? Let's see if that jumps on screen. It did. Good. Yeah, really good question, and a very fair question. And I'll tell you, there's kind of a tale of two cities almost. One would be Europe, and the other would be the U.S., right? Both regions kind of have it wrong, right? But the U.S., for whatever reason, decided, because of kind of a more Keynesian push from policymakers, that government spending was going to be necessary, and that we weren't going to have any sort of ceiling on government spending. But if you look at something like Europe over the last decade and a half, and especially the 10 years following the Great Financial Crisis, they did. The Maastricht Treaty and the various other regulations really put a cap on government spending, and there's a reason the U.S. has just outpaced the rest of the developed world in regard to growth, and that's just because, for whatever reason, they ignored the policymakers, or at least the policy advocates, who were concerned about too much government spending, and the government spending made it and was able to continue to have growth during a time frame where most of the world, especially the world that was imposing austerity at the time, didn't have that growth. And so I would say, compare the U.S. to, say, Europe, for example, where there was a lot of austerity. And you'll see really those two pictures get painted. And I will say too, I mean, I don't like to get too much into policy and whatnot, but had the Fed and had the government had more aggressive spending policies, we could probably be in a better place now than we would have been had we not. So, and then the other thing too is a lot of the concern of, I don't want to call it anti-MMT crowd, because at that time there was no such thing as anti-MMT, but certainly the deficit hawks at the time, and those most concerned about deficit spending going back to, say, 2009, right? I mean, what were their calls? Their calls were for a complete collapse of the dollar if we're going to spend like this. There were calls for inflation. It was calls for rates to spiral out of control because no one's going to want to borrow from the U.S. I mean, everyone, top to bottom, left and right, was all calling for these things, while this small club of MMTers were saying, no, that's not how this is going to pan out, right? You don't get inflation with 0% interest rates. We're never going to become Greece. We're always going to be able to pay the bill on pay the Treasury bill on interest, right? I mean, down the line of everything that everyone was saying was going to be the big concern never ended up actually playing out. So, from my perspective, what played out over the last 15 years, God, this, sorry, something else is bothering me. Yeah, what played out the last 15 years is absolute vindication of what MMT was, and absolutely absolutely, I think was, I mean, and thankfully, two policymakers weren't actually drinking their own Kool-Aid, or those that were concerned, and yeah, things played out kind of exactly as I think you would have expected. Yeah, so good question. Glad you brought that up. All right, let's see. What else do we got in chat? I'm kind of going through things. All right, I think we've hit the main parts of chat. I'm trying to think, what do I want to do next? Let's see. Do we want to debunk Bob Murphy, or do we want to go down the path of what was the other topic I had for tonight? I'm drawing a blank now. What did I say we were going to do tonight? Market sell-off. Oh yeah. Do we want to look at the tax flow model, or do we want to debunk Bob Murphy? I think I want to do the tax flow model next, and then we'll save Bob Murphy for the end here. All right, so tax flow model. Why does this even matter? Why does the whole tax thing even matter? I'm going to pull up the Fred real quick. And again, we kind of got to set the stage for tax flows here. So one of the most important data series we can follow, besides government spending, is going to be credit. Save Bob Murphy. One of the most important data series you can follow is credit. And the reason for that is, one, it really is the main driver for what we see as economic activity, right? It's the credit cycle that drives the business cycle, and so on and so forth, right? So that really is one of the most important things. The next thing is the cycle in particular is sensitive to, or probably the most sensitive to, the potential of kind of creating economic crashes, right? I mean, it's a credit cycle that, when it was contracted in 2000 and 2008, that created those recessions. And so understanding where the credit cycle is can tell us where the business cycle is, and can give us a good lead on when the worst of it is about to happen, or when the best of it is about to happen. And so I have a lot of content on the YouTube channel regarding this, so we won't spend too much time here, but here's the BIS total credit to the private non-financial sector, again, for the U.S. So this is all private debt, pretty much, right? I mean, this is the key time series that you want to understand. And then what I've done is I've applied a year-over-year change, so we can see effectively the flow of this year-over-year. And the first thing that should strike you here is that it is a cycle. It goes up and down, right? I know that's pretty simple, but it's a cycle. It goes up and down. What do I mean by that? Why is that important? Is that it's inherently cyclical, right? Is that it is a dynamical system that will cycle over time, effectively all by itself, right? It is because of the non-linearities of the way the system works, it's going to cycle over time, higher and lower, until the system finally busts, right? And that is a direct insight from Steve Keen, from the work that he's done. I highly recommend his, if you look up on YouTube, Steve Keen, Minsky at 100. He's got the best presentation he has with what he's done with his mathematical models and his what's called his Minsky software. And he really demonstrates well what the underlying math is. But it's a cycle, and the cycle moves up and down. And what you'll realize, and again, because it's a nonlinear system, and it's inherently cyclical and dynamical, and what you'll realize is if you overlay this with something like the Wilshire 5000, unfortunately they don't have S&P data on the Fred, but if you overlay this with the change in equities, we'll go ahead and put these on separate axes, you realize that there's a pretty strong correlation between markets and between the credit cycle. Certainly not a one-for-one, but it undoubtedly follows that if there's a sudden credit expansion, that the implication of that is that new money is being created, and that new money being created is causing business activity to occur. So on the way up, you're getting an expansion of business activity. On the way down, you're getting a deceleration or a contraction of business activity. And so what you'll note is during that initial acceleration phase, that's when growth accelerates at its fastest level. And then during that contraction phase, that's when you get into the recession. And I think I see a chat here that says, what are those gray lines? Those gray lines are recessions. And so when credit contracts, that contracts into a recession. So what is credit telling us? Credit is telling us where we are at within the business cycle, and that it is really one of the most important features to let us know where we're at in the business cycle, and equally where equities are likely headed. The problem with the BIS data is, I guess I should say the plus for the BIS data relative to the H.8 bank credit data is that the BIS is the broadest. I mean, it's like 40 trillion in terms of what it tracks, whereas the BIS, where the H.8 credit is like 25 trillion. So it's the broadest measure of bank credit, but it's lagged. It's lagged by like 6 months, right? So by the time this thing prints, it has data that's almost, I think, up to 9 months old in it that you're just finally seeing. And so it's always late to the game, right? I mean, we know what's happening by the time this data can confirm. But there's a back door to this, right? And the back door is all business activity leaves a mark in the we'll call it the data tables, right? It leaves a mark in the accounting record. And that mark is taxes, right? So if taxes are increasing, that means business activity is increasing. And if business activity is increasing, it's likely because of one of two, well, it has to be really because of one of two things. Either one, we've had more government spending occur, right? So that's that vertical line in terms of the vertical and horizontal money. We have vertical money coming in, and that can spur on business activity. Or the horizontal money is increasing, and that's that endogenous money creation that's increasing. And so taxes are evidence that we're seeing an expansion of one of those two cycles. What I want to do now, real quick, is just to show this. Is I'm gonna pull up tax receipts. I'm gonna pull this up on a separate tab, and that was the time series we wanted. So we're going to go ahead and pull in current tax receipts. We'll add this just like we did with stocks, and we'll put these on separate axes, and we will go ahead and percent change year over year, and we'll switch this to percent change year over year as well. And you end up seeing a pretty strong correlation here between taxes and the credit cycle. Now you might think, okay, well, why not just use the tax receipts? It seems to be a little bit more up to date on the FRED. Well, the problem is this too is a bit delayed. So what we can do is we do actually have a real-time record of taxes in the daily treasury statement. And in fact, that is effectively what, and if you calculate the deposits from the daily treasury statement, which are the money that the federal government is receiving back in, 90% of that is taxes. And of those taxes, 80% of that is FICA taxes. So the idea is taxes can give us as early as we can possibly get indication of where bank credit is headed and where the overall kind of endogenous money cycle is headed. And again, that matters, and we care about that because the endogenous cycle lets us know kind of the health of the credit cycle. And the idea was that we wanted to build a model or a tool or an indicator based on taxes to give us the most real-time understanding as possible as we could of bank credit based on those taxes. Yeah, bank credit equals loans, netty. All right, so I'm going to pull up VS Code and jump over to, we're not going to code tonight. Again, I even recognize that was a little rough to go through. So let me go ahead and pull this up, and we will, we'll go ahead and go through the Jupyter Notebook real quick. Long story short, just to kind of go through this, I pull in all the data from the daily treasury statement. We go ahead and you kind of have to create effectively what are some pivot tables to get the actual transactions, and then out of those transactions, we're just going to pull out the spending that's occurring. I'm sorry, the deposits that are occurring because of taxes. And here's the main thing. If you want to kind of build this at home, here's the thing that I ultimately noticed. What I was trying to do was essentially take the quarterly data that we saw from the tax receipts on the FRED database and just kind of add to that, continue to add to that from the daily treasury statement. But it just never turned out right. I don't know what the problem was, but I don't know if it was, I mean, I think I adjusted for like billions versus millions in reporting. I think I adjusted for everything, but it just never was able to look correct. And so what I realized is, okay, why don't I just accumulate all taxes received up to the start of where we get the daily treasury statement from, and then build upon that, right? And then have it continue to accumulate so we get the total amount of the entire stock of taxes that have ever been received. So what I did is I actually took that, let's see if this, I think I could probably forget there we go, the zoom in button. So what I did is I actually took the total spending that took place, the total receipts that took place in taxes going back to 2005 when the daily treasury statement data begins, at least the data you can get with the API in 2005, and add that to the first row. So the first row is massive, so that would be, this is in millions, so we'd add a couple more zeros to this, so it'd be like, what, 93 quadrillion? Am I right in that? We've received a lot of taxes in the history of the U.S., but this was effectively my estimate of how much taxes we'd received up to that point, and then from that point forward, we start to add the tax receipt for each day going forward. So again, if you're looking to build something like this, this is the first step that you want to take, is you want to estimate the total amount that have been received so far, because what we're going to do from this is we're going to get the stock, and then we're going to ultimately estimate or construct the flow given the overall stock here. All right, moving forward from here, then we do a cumulative total here, and so now we have the total cumulative total of all taxes received, and then we're going to create a percent change from there based on the daily treasury statement, and that's going to give you, now I'm realizing I need to actually zoom back out so this shows, that's going to give you then this overall trend of tax receipts. And in fact, if you overlay this in and of itself with like the stock market, it actually has a pretty strong correlation overall. But even then, this still wasn't exactly what I wanted. Obviously, we had a big sell-off in 2022, even while taxes were pushing higher, and this also didn't correlate perfectly with credit as well, because we saw the big credit crunch that took place during 2022 likewise, and so wasn't exactly what I wanted. And I've gotten to this spot a few times, and I really just kind of scratched my head as to why this should correlate the way that I think it does, and it's because I just realized I need to take it one more step further. And that next step further is to take yet another, the second derivative further, right? The change in the rate of change. And that got me, so I mean, I guess you could call it the acceleration of taxes. And that got me to this final chart here, which if we scroll on down, and then I apply just a 30-day moving average, because the reporting days every year are a little off, and you get these kind of noisy spikes that occur. So if you just do the 30-day moving average, you get a pretty good track of where those tax receipts are at. And then the final step is to go ahead and pull in the credit data that we just saw after that we just had up from the FRED. And if we overlay that, you end up seeing a very, very strong correlation between the two, and it gives us that full picture at this point. And this correlates very strong with the H.8 credit data. So position, velocity, acceleration, surge, snap, crackle, pop. Yes, yeah, you just got to keep digging. You just got to keep digging deeper in it. Yeah, because the surge, snap, crackle, and pop, those are terms that are actually used in physics, correct? Isn't snap one of them? I think it is. I think they all are physics terms. Anyway, it gives us as good as we can real-time understanding of where we're at in that surges. Okay, in that credit cycle. So I'm very thrilled with what we're seeing here. It's exactly, I mean, here's the thing. It may be a little anticlimactic because it's exactly what we thought we would have seen. But taxes are starting to push higher here. I think, Ghost, you're the chat is distracting me a little bit here because I think one of those actually is I think the third derivative, the derivative after acceleration, is one of those, snap or something like that. Anyway, it is exactly what we would expect here. We're starting to see the taxes push higher here, and that is a direct result of the expanding credit that we're seeing, and that plays in really nicely with where we're at overall in the current business cycle. Because if I jump over, speaking about where we're at in the current business, jerk, bully pulpit, jerk is what I'm thinking of. Yes, thanks, man. I appreciate that. That is exactly what I had in mind, and I'm realizing on my VS code that the overlay isn't right, so we'll fix that. Still not right. There we go. Jerk. Yeah, jerk was it. All right, so where are we at in the current credit cycle or current business cycle? And I posted this on Twitter, but it's worth pointing out here. And if we zoom on in, it's going to take me a second to drag this over. But if we zoom on in, we are starting to see in kind of a continuation of deficit spending pushing lower and lower here. The deficit, the monthly Treasury statement came out, I think, about a week ago. And so we were able to update our monthly Treasury statement cumulative deficit spending chart here. And we're continuing to see this deficit spending wane. Now, the deficit spending waning is just a natural progression of kind of how the spending cycle works. There's generally speaking, there's the reaction that happens as the automatic stabilizers kick in after a recession, and then those automatic stabilizers cool down. Obviously, we didn't have the automatic stabilizers kick in after 2022. It was just the interest income that was coming, but we're starting to see the natural waning of just kind of that bullwhip effect of spending coming or going, and we're kind of settling into what will likely be just kind of the normal spot here for spending into the remainder of the cycle. But what is happening is we're transitioning from this time period where fiscal was really the dominant force in growth, certainly late 2022 as we headed into 2023, now where we're seeing this pickup in the credit cycle starting to turn on here. And we know that because we're seeing the tax receipts kick up, and that's giving us the indication that the credit cycle is starting back up again. And if you recall, at the end of 2022, everyone was screaming, "Oh, we've never seen MMT or M2 contracting this much. We've never seen credit contracting this much without a recession," and everyone was freaking out. Well, if you go back and look at the tax data, early 2023, we were starting to see the tax data really reaccelerate. Of course, we had massive fiscal at that time anyway. So we knew that credit cycle was ready to kick off at that time. And again, those tax receipts just give us the earliest indication that part of the cycle is turning on, and that we don't need to be all that concerned immediately about the downward draw, if you will, of deficit spending, because the credit cycle was starting to turn on at that point. So we are starting to see this transition from government spending being the predominant force in growth, and more importantly in terms of equity expansion, to this credit cycle being now the kind of more important force in. I think I mentioned this in the past few updates or in the past few live streams, that this will likely hold for and can hold the growth for quite a while to come here, and as long as we don't see a sudden and immediate collapse of deficit spending. The one thing that could get out of control here is if oil really starts to shoot higher, inflation really starts to take off, which it very well could. We continue to get these surprises to the upside in inflation, and Vladimir, this is deficit spending adjusted for inflation. And so if inflation really starts to push off, the efficacy of each new dollar coming into the private sector is diminished because of inflation, and so in real terms, we could actually start to see ourselves in a surplus, exactly like we saw in 2022. And if that were to be the case, that could get dicey again. But unlike 2022, we are just starting off the credit cycle, and one of the things we know is that the credit cycle just runs its course, right? Once the credit cycle starts its push higher, it has the momentum to carry itself higher effectively, short of any major policy change. The policy change that could come in and shift all of that is if the Fed were to cut rates all of a sudden in a dramatic fashion. But based on where the CME data is and all that, I'm not anticipating a sudden cut anytime soon. So at this point, I still anticipate the longer term bull run here to push forward. On the short run, of course, as we've gone over, flows are collapsing in April, and certainly we've been anticipating a pullback into the end of April here and probably through May. So this is this argument that I've just put out over the last few minutes here is a longer term argument, not a shorter term argument. And certainly on the shorter run, things could get dicey. And depending on how big the tax drain gets, we could really see deficit spending take a hit here, and not a replay of 2022, but we could really see a lot of liquidity removed, and the implication of that could be a lot of pressure on markets. But longer term, we're seeing a lot of strength from the credit cycle at this point, and so I'm not. Yeah, obviously not anywhere concerned about a recession at any time. Although I have to admit, I obviously don't want a recession. I want a strong economy and would love for this bull market to continue on forever. But I have to admit, it will be kind of nice if we finally get a recession and I can stop being accused of just being a perma bull. I had someone call me out as a perma bull and that this only works because stocks go up forever and that sort of thing. And I promise you in 2022 I was bearish. I promise you I will be bearish again when the data points to being bearish. And obviously I think this whole applied MMT approach will be capable of recognizing that, and that will be the outcome if and when we get there. So I'll post a full thread on Twitter regarding the whole tax thing and that tool. And the goal here too, just so you know, the goal here, and if you're wondering why do I keep building out these little niche tools, these little niche indicators, the whole point of all of this is that each one of these indicators, each one of these tools, this is in real time. This is feature engineering, right? What I am building is a feature that gives us information about, and I'm using information in a statistical sense, in a like a number theory sense. It gives us information about where markets are headed, right? So, and it's doing it is giving us the most amount of information about where markets are headed. And so I'm engineering these features, and these features are just going to be more features that get added to the next iteration of deep MMT, right? So the whole idea of all of this is to continue to work this data out better and more precisely, to engineer it where we're getting peak information out of the data to feed into the deep learning model, so the deep learning model is less distracted by noise and can kind of feed off more just kind of the direct inputs that are actually the most important that are most important features for actually predicting the outcome of where markets are headed. So that's why I'm building all these things up, is they're just going to continue to add to make an even more accurate deep MMT that is able to kind of better generalize the underlying principles of MMT and the model itself, and then extrapolate those out into a regression style model. So that's the end game. We're building the Death Star here, and sooner or later, this thing is going to be the most powerful force in the universe. I never watched the end of Star Wars, so don't tell me how it ends for the for the Death Star, but. Let's see. We will change gears here. Now, we'll hit up chat for just a second and see if anything's come in. I've been kind of just paying attention to the presentation. I don't think I'm seeing anything come in chat-wise. Here we go. Nettie. So on the DTS, if deposits are greater than withdrawals on a particular day, that is net money removed from the economy. Exactly. Yep. Yeah, actually, I'm glad you brought that up. I'm glad you brought it up and stated it that way, because one way you can look at this is if you take the, if you head on back, I'm going to head on back to AppliedMMT.com and our data dashboard. I have withdrawals and deposits that you can turn on from the tool here for the daily treasury statement, and this is absolutely. I mean, you can just see it very visually nicely here. But if we just zoom on in during the time period heading into the great financial crisis and then after, right, withdrawals are money coming out of the economy, right? So net financial assets being removed from the economy. Deposits are net financial assets being removed from the economy. Withdrawals are spending heading into the private sector. So adding net financial assets to the private sector, and you can see that withdrawals were under deposits for quite a lot of the buildup into to late 2027 or 2007, 2008, and that's ultimately what caused the great financial crisis. So, yeah, exactly. The difference before and after is quite striking. So, a couple takeaways here too. One of the things is, again, since we just talked about taxes increasing because credit increasing, right? Realize that the deposits here are 90% taxes, right? So taxes were increasing into the great financial crisis, which means the credit cycle was accelerating into the great financial crisis. So these taxes are a double-edged sword, and it's part of the nonlinearity of the whole system that eventually the taxes get more than and surpass the spending that's coming out, and you actually get yourself into a surplus situation. So if you do see a strong acceleration in the credit cycle, you need to the taxes will tell you that it's taking off, but it will also demonstrate when the taxes are just getting too heavy or surpassing what is actually being spent, and it can be kind of a double-edged sword. So you do get that tax growth that increases because of that endogenous cycle expansion, and it's kind of like a bracket creep almost to government spending. And then that can prick the bubble in and of itself. So we do got to be careful of that as we head later on into in the cycle. Again, I'm not anticipating this until at the very earliest 2025. But yeah, I'm glad you stated that question that way, because it reminded me to show the demonstration here. And this is a really cool visualization of how the two interact between spending and taxes. All right, I think it's time for some debunking Bob Murphy here. So I got to bring back up the VS Code here, and we will switch back over to VS Code. No, what I want to do first, I think it would make more sense to put the tweet on screen here. That is not what I wanted. That is what I wanted. Okay, Bob Murphy is not trolling. Everyone, I beg you, look at this chart. As Fed funds began rising, or as the Fed began raising rates, red line, year-over-year consumer inflation. Don't feel bad for Bob. He takes his shots. Me too. Year-over-year consumer inflation, blue line, started falling. Then they both stabilized at just about the same time, and yet Kelton is running victory laps saying the opposite. So the victory laps that we've been running is as rates got pushed up, my theory, my interpretation of this was that we went over this in the last stream, but my interpretation, my theory of this is that as the Fed raises rates, that makes things more expensive and adds additional interest income to the private sector to support that higher price structure, and therefore you get inflation, and you get inflation to match and converge on the policy rate, and that's where inflation drifts over time. And so that's effectively what MMT has been saying, is that, hey, you've likely got this interest rate thing backwards. And the thing that we pointed out last week is Bob just needs to kind of zoom on out in terms of these two lines here, because if you actually, we'll just go CPI, we'll pull up the CPI, we'll do year over year, and then we'll go ahead and add Fed funds, and we'll set to separate axes, and Fed funds, we don't want the percent change. We just want to go ahead and do the rate itself, at least for demonstrative purposes here. And what you'll see is you'll see throughout the entirety of the two time series, they correlate quite closely here. And what he's zooming in and pointing out is that when the Fed raised rates, when the Fed raised rates, that is at the exact same time that consumer inflation started rolling over right at the same time, that there would be like a causal link there. And one of the things we pointed out last week as well, and actually, you know what, I can pull this up real quick. I'll turn on VS Code. Give me just a second. It'll take a second to pull up. But what we pointed out last week was that a far better explainer of what was actually taking place with supply chains. And in fact, I've done threads on this in the past that have really shown that supply seems to be the most predominant driver of CPI and the change of inflation. And that, I mean, as you can see, CPI very clearly correlates with the global supply chain pressure index that the New York Fed puts out. And this should be no surprise to anyone here. Now, is this the only factor that contributes to inflation? No. But in terms of the worst of inflation, you're going to get the worst of it when supply is taking the biggest hit. And there are various reasons that supply might take a big hit and whatnot. But to me, this is the first place to look. And obviously oil and other in any oil sensitive commodity is going to play heavy into this. And if oil gets overly priced, that's going to put pressure in and of itself on the supply chain, because it's just hard to purchase oil at a higher price. And we've gone over the impact of what oil has been in the past, but it's effectively just kind of a tax on the overall private sector. So either way, supply is a far more better indicator of where inflation is going. And then, of course, the other joke you can make is, I think it was like literally like the week, it was like August or whatever, 2022, that inflation peaked. You actually saw Biden pass the Inflation Reduction Act, or whatever it was called, that kicked off millions and millions or billions and billions, if not trillions, of spending. And so no one would point to that and say, okay, Biden passed some bill to reduce inflation and therefore inflation reduced. Just as I think it's a bit spurious to point to what Bob is pointing to and say this was a causal effect. But and this is where I do have a bit of an expertise, and certainly a lot of the work I've put in over the years. What we can do is, taking the longer term time series, is we can run statistical tests on those time series to see if one has forecastability to the other. And to me, this is kind of where the debunk is. So how I want to debunk what Bob Murphy is saying here is by simply stating that if interest rates have some sort of causal mechanism towards inflation, then we should be able to detect that statistically. And I don't even think, necessarily, I don't think it doesn't have to be the case, right? I mean, my argument for why you would actually see a causal connection between interest rates and inflation, so the interest rate causing inflation to decrease, would be that, let me think this through. I had a good. Oh yeah. Why there would be at least a detectable causality there is simply because the Fed raises rates incorrectly to kill inflation, right? So the reason there's a correlation in where you could even potentially detect the causal connection there is because the Fed is looking out at inflation. It sees inflation push higher, and it's like, hey, I got to raise rates, right? That's what I do to stymie inflation. And then eventually they think they get it right for some reason, and then kill rates, push rates lower, when they start to see the inevitable rollover of the business cycle. So I can understand that argument, and why there might be some causality, but we can also detect or see if there's a detection the other way around, right? And my guess would be that you might actually detect forecastability both directions. But the question is, what is the correlation, right? Is the correlation positive or negative in terms of the kind of causal lag? Right, because if it's positive, then and the correlation remains positive, then we're not seeing this massive negative correlation between the two that you would expect if hiking rates is actually pushing inflation lower. So what I would do if I was Bob is I would look at a chart and I would say, hey, look, maybe there's a causal reality here, and maybe an even better way to put this would be to go ahead and I'm gonna take one of these time series and I'm gonna say we'll say A times a -1, so that will invert the Fed funds rate. And then, if you really want to queue this up, right? Yeah, you do something like that and say, oh yeah, look, right? There's a direct correlation, and it's slightly lagged. To my eye, this looks right. And so you can do this, and this is where all analysis should begin. Right? Just looking at charts, seeing patterns. But your eye can deceive you, and you certainly want a more robust statistical analysis of things that you might see as a correlation. And so that's exactly what we're going to do. We're going to see what we can detect using various statistical tools, and see what we can get out of this. So what we're going to do is we're going to pull in the CPI data and the Fed funds rate, and you can see those are the same two series directly from the Fed. And we're going to do these as a percent change year over year, and then we're going to normalize them. This is necessary for Granger cause testing. Then we're going to go ahead and run these through the Granger cause tests. Now, what we're looking for is we're actually trying to, off the top of my head, I'm forgetting exactly how they put this in statistics. Yeah, we're trying to reject the null hypothesis. So in this case, the null hypothesis is that for this first one is that inflation does not Granger cause the Fed funds rate, right? So that's what we're trying to reject. So we're going to reject that, then we'll actually get a positive Granger cause test. So we'd actually say that inflation is Granger causing the Fed funds rate. And we're going to run this over 12 lags, so that's a year. This comes out each month. And we're looking for a p-value under 5, quite often in highly correlated time series. You'll get the first time series to be a positive Granger cause test, which we do, so that's fine. And what we want to do is see further down in time at more lags, do we get a p-value less than 0.05? And we do in fact get that p-value at lag 3, at lag 4, and at lag 5, and at lag 6 and lag 7 and lag 8. Now our chi-square is starting to blow out a little bit, so the efficacy here is diminishing, but we are seeing that in fact inflation as a variable has forecastability for the Fed's fund rate. And we were talking about why this might be the case, right? Is that one theory could be that it just is in fact pushing the rate around, or that the Fed is looking out and the Fed is looking out at inflation and moving that rate based on that. So we also want to run it in the opposite direction. And when we run it in the opposite direction, we get the exact same reading, almost exactly the same. A positive right at 0, or at 1 lag, which you would expect. And then as we go down the ladder further down, we continue to see a rejection of the null hypothesis. So meaning that the Fed's fund rate is Granger causing in both directions. So this isn't too far off of our expectation, but the point is in both directions. Give me one second here, chat. It's not what I wanted. All right, well, I'll come back to that. All right. So we're getting a detection, a positive Granger cause test in both directions. So the other thing we want to do too is just run some kind of classic correlation test just to see what the implication is of the correlation. And I mean, effectively what we find is that they're positively correlated, just meaning that I think this kind of undermines to me, meaning the fact that we detect Granger causality and they're positively correlated, that in any way higher rates is somehow pushing inflation lower. And in fact, I don't think, and I've asked for this on Twitter, and people will give me certain studies that have been done on non-U.S. countries like emerging market countries, but I've never seen anything that Fed's put out or anything that I would call kind of credible based specifically on the U.S. that's ever shown an analysis on the long and variable lag line that they use that shows anything like this to show that there's any reason to believe that the higher rates are actually under any time horizon ever pushing inflation lower. So either way, the regression analysis shows that it seems to be a positive correlation, and we're detecting relatively immediately within 6 months some forecastability. The next thing we can run, though, and this is really where we can kind of now face off the two variables from one another, right? And see which is giving us more information and which is kind of the stronger variable impacting the other. And this is called convergent cross map. And again, this is just kind of part of the tool set that you use when you're trying to determine the statistical viability of your own causal inference structure here. And so it's a bit complicated. You can look it up. By that, I just mean I don't have a quick pithy explanation of convergent cross mapping, other than it's kind of operating like Granger cause, but it's operating over this manifold property of each variable and these various embedding dimensions. And to be quite honest, it's been a while since I've been in statistics to be the explainer of exactly what this thing is doing. But it's a very, very good tool to allow two things where you're detecting causality or at least forecastability to determine which seems to have the stronger result that's pushing the outcome even more. So we set up our results for, in this case, for Fed funds and its impact on CPI and then CPI on Fed funds. And when you finally plot the result, what you're looking for is effectively the higher mapping skill is the higher determining factor from one variable to the next. So Fed funds to CPI has this higher cross-mapping skill, right? And the closer you get to one, the more of a direct cause that it is. So by no means are these at one or near one, but certainly between the two, if we're going to have a debate in terms of like what is actually happening with Fed funds to CPI, the debate has to be that Fed funds is certainly causing something to happen in CPI, that it's detectable, and that it's a positive correlation, right? So from my perspective, as I build my deep learning models and I construct them and inform them in an MMT informed way, I'm putting these constraints on them to understand that Fed funds is likely a forecaster, not a forecastee of inflation, and that while Fed funds is being influenced by where inflation is, that above all else it's influencing inflation more so. And so going back to Bob's tweet, if we switch back to that screen and kind of the emphasis that he was trying to have, it's that the lag is about 6 months, maybe a year at best, but we're looking at about 6 months after what seems to be the initial impulse, and then we should expect isolated. Obviously, there are many variables, confounding variables. There's a lot that's taking place, but the impact of rates on inflation is thoroughly detectable, and it seems to be, 6 months or so in terms of when we'd expect it to start to show up. So, look, this is, I know the Austrian school poo-poos empirics, and I know they poo-poo statistics, and this is outside of how they think that macro should be done, but I think there's a lot of merit to be had to this approach, and it's kind of no surprise to me then that if you're unwilling to take in and allow empirics to speak to your theory, that you're going to have the sort of kind of predictions that they had, where at the end of 2022 into early 2023 they were absolutely we're going to have a recession in 2023, and then it was 2020 early 2024, and now it's mid to late 2024, right? They just were so wrong on their predictions because they just do not allow the data itself to speak to the theory and inform and correct the theory, and to me, I would be doing that if what I'm looking for is an accurate prediction. But if I'm looking for more just to kind of inform policy or to kind of go on my political rants or whatever, say how I hate the big government or whatever, then clearly I'm not going to want my theory to be informed, because it's going to kind of undermine, what it is that I'm trying to advocate for in terms of policy or just kind of broader macro understanding. So that is, that's Meet Debunking Bob. I mean, that's kind of my take on Debunking Bob here, is that ultimately, from all the statistical work that I've done, I've yet to detect any long and variable lags where higher rates are in any way going to in any way diminish inflation into the future. So that is me debunking Bob for tonight. Bob, if you see this and you want to come chat, by all means, let me know, and we can go over that, and you can debunk my debunk. All right, let's see where chat is at now. I've been missing a lot of chat on the way down. Also, how you doing tonight, chat? Doing good? Good. I'm feeling good. I gotta admit, I was calling for, I've been calling for a top in markets for the past couple weeks now, and put out a tweet, I think at the end of March, just kind of showing one of the tools we have, the sentiment flow tool, showing that, we're probably close to a top soon, and not that I like stocks crashing or necessarily, but it feels good. It feels good to finally see markets kind of cool off here, and hopefully we catch soon in May, June, and we start the rally all over again, as I think the flows seem to anticipate. Nettie, why do they move in sync with each other? I think what you're saying is why do spending and taxes move in sync with each other directly? Like, why are they in lockstep? I think, is that what you're asking? It's kind of a good question. I'm trying to think this through. Let me pull back up the data here. Give me 1 second. So your question is, why are both of these acting in lockstep? I think it's because, more than anything else, the days in which spending occur are the same days in which tax deposits have to come in. I think that's what it is. I think they both occur on the same time frame, like both the same. They both happen on the same day. I think that's probably a lot of it. Is the day that taxes are due is the same day that a lot of spending goes out, and that's why they remain in lockstep. Good question, though. I guess I'd never noticed that before, that they are in lockstep, and that isn't necessarily self-explanatory. Let's see. Blair Fix had fun with interest rate relation to inflation. He wrote an article about rising wages to tame inflation. Yeah, I think I saw that. That was a little while back, but yeah, that was good. All right. Ghost on the half shell. Does the notion that interest must show up as inflation or austerity? It's inflation for those who can raise prices and austerity for those who can't. Yeah, that's a very valid point. Yeah, Vladimir, at this pace, inflation is starting to head toward the policy rate. Zero Shot, man, welcome back. Haven't seen you in a while. Glad to see you back in chat. Charles Grip, haven't seen you either. Thanks for joining. We're not into the whole data thing. Yeah, I mean that was Pear's big point. Is that that it's data can only help you understand your theory, not inform your theory at all. Let's see here. Douglas, what do you think will be a reaction function when the equity from the equity market to the first announcement of the first reduction of the policy rate? If there ever is one, I mean, at this point, it's looking like there's never going to be a reduction of the policy rate. And I think to a certain extent, the selling we're seeing is the immediate realization that the expectation for a rate cut isn't happening. So the one immediate thing that will happen with rate cuts is there is like a discounted cash flow model approach that there's that is used to value stocks in the short run. So all the models, when it was kind of realized that the rate cuts weren't going to happen, they all immediately have to reprice based on this new projected reality of where rates are at, and that has an immediate repricing lower. And I think that's part of what we're seeing right now. And if the Fed comes out and says, without a doubt, 100%, no matter what, we're going to cut, then we'll see the repricing happen once again, and we'll see the stock market readjust upwards. But then eventually the flows overtake, and the flows will just be the predominant factor once again. So on the short run, if the Fed were to come out and say, yep, we're absolutely going to cut, I think that would boost markets momentarily for a couple weeks, and then we just have things normalize, and then they would track flows once again, very similar to what we've seen over the last few years. Larry Summers, glad to see you here. Thanks for dropping by. Figured by now you would have learned something, but still holding on. Still holding on. Yeah, Nettie, in terms of the double-edged sword with taxes, right? So as taxes increase, that's creating more of a drain from those net financial assets in the private sector. So it's a double-edged sword in that sense, right? Like at the end of the day, when we get ourselves into a surplus, and assuming the government's still spending, it's literally the private sector that is now supplying the necessary liquidity for the government to spend, right? It really is the Austrian monetarist dream state, right? It's the state they think that actually the world exists, right? And so when the government is still spending, but it's just spending the tax receipts, it's literally the private sector that's going into debt to fund the government at that point. And we can get ourselves into that scenario if the credit expansion happens enough to where the taxes that have to be spent because of the business activity that's taking place because of the credit expansion is putting the government into a surplus. So that is why it can become kind of a double-edged sword, as it can fuel the credit expansion that's taking place. JS, did I follow the model and sell with the model? Yeah, I did. I follow my model. Sold a little early, but at this point, in terms of the timing, yeah, I got it good. I'm already hopefully going to be able to buy back at a much better price. Yeah, for the most part, I do use the models I build. I'm not a super active trader. In fact, I'm trying to think, when is the last real trade that I had? I think the last time I had really took any real activity was in October, when I went long into the big rally that we just had. So yeah, really the first trade in about 4 or 5 months for me. But yeah, I'm not terribly active. If I wasn't doing the AppliedMMT stuff, if I wasn't doing all the YouTube stuff, the updates, and I didn't have a community that we were supporting and all that, I could focus day in and day out on markets, I'd probably be willing to trade a little bit more often. But admittedly, a lot of my time has to be focused on other things, and I don't even know if I could really eke out much of an edge more if I was really, really actively trading. So I'm not too I just don't know how much I'm really missing out on. But maybe one of these days, if I really just get if I'm really just finally happy with it, where everything's at in terms of where we have AppliedMMT, then maybe I'll get a little bit more active. But on average, that's really what I'm looking for. I'm looking for the moves like the July to October sell-off, like the sell-off we're likely to have, like the big rally that we had at the end of last year and at the beginning of this year. I mean, those are the swings I'm trying to catch, and I'm not too worried about the smaller swings that play out in the interim. Brian, nice, got the taxes done. I think I finished mine up about a week ago as well. It sucked. No fun. Charles, I've always understood, and I think I understand velocity a little bit more differently than kind of a monetarist or a neoclassical would understand velocity of money. But for me, velocity is just, if you were to be able to track kind of the circuit of money going like any given dollar going through the circuit. That would be velocity in terms of over any arbitrary time frame. How fast does any given dollar make it through the circuit? That's how I would kind of define velocity. And everything I can tell, higher interest rates actually increase velocity, and there's a positive correlation there between higher interest rates and velocity. And to me, that actually boosts, or at least in terms of how I understand what Minsky is saying, and kind of the heterodox approach is saying, is that that's actually boosting economic activity. Now, it's likely a result of what rates are actually doing under the hood for the credit structure and whatnot. So that's kind of how I would read it. Ludwig von Mises is my hero. Did you see that the MMA fighter after he won shot out Mises and Hayek and stuff? That was hilarious. Poor guy's going to cost a lot of people a lot of money, but whatever. Whatever. Douglas, do your MMT tools allow you to best the market? If so, do you post your trades publicly? I don't post trades directly publicly. Yes, they help me best the market. Given what we are now, and given what the lawyers tell me, it's not best to post trades public under the structure that we have. If you ask me though where I'm positioned, I'll absolutely tell you. And I have no qualm with that. I'm effectively 100% hedged, so I'm effectively in cash, and I would benefit here if markets sold off, kind of a lot, if you will. So I have a bit. The hedge I have on is a bit of a asymmetrical hedge. If crap really hits the fan, otherwise I'm effectively in cash, given where we're at. And at this point, we'll likely be probably until May. That'd be my guess is when this pullback will be. But we'll see how the data plays out, and I could get in sooner, but I am a bit concerned about where markets are at. I mean, they are very, very brittle, and things could end up getting even nastier than kind of I anticipate. But either way, I have been happily in cash throughout, I think, most of March, and we'll kind of continue to, or at least hedge through most of March. And at this point, I'm not terribly concerned about the last little bit of the rally that I missed out on. I mean, I'm already kind of better off than I had been trying to absolutely time the top here. So I'm content where I'm at, and we'll certainly most likely get a strong rally into the summertime, and I will follow that higher. And if things get really bad, then no harm to me. So I'm not too upset about that. Yes, Larry Summers, banks lend out reserves. This is to households. I know your arch enemy Steve Keen has a post that he made on this recently that clearly demonstrates this case. Yeah, regarding like the track record and how and the efficacy, Jesus, the efficacy of kind of what we're doing here. I mean, one, I think my track record speaks for itself. Two, I mean, I can tell that just based on kind of subscriber retention and whatnot, that people are clearly getting something out of this. I mean, I know, a handful of people who reach out to me directly and kind of telling me where they're at. I know they're doing better than I am using the exact same tool set I have. So in terms of the the ability to use this sort of data, I think it's absolutely there. If it wasn't, I certainly wouldn't be doing this at this point. I feel pretty damn confident in the tools that I've used, and I feel like I can very clearly demonstrate and show at least on a statistical level where the connection is, and you can take it for what it is based on that. Larry Summers, America is the best. Yes. Better than Canada. All right. Let's see. I'm not seeing too much else tonight. I think I've gone over the main stuff that I wanted to hit for tonight's stream. If there's any other questions. Oh, no, I've got two more things. Before we finish up, I've got two more things, and I'm really glad Stephanie Kelton tweeted this out. But Riddick Goyle, great discussion. I agree with the economic burrow, I think is the name of the podcast. Again, I think Riddick's understanding here of what's happening with the credit cycle is as good as anyone. And I thought the conversation that took place as well was really good, because I think the questions they were coming from a good angle to kind of elicit what was going on. So a great discussion if you haven't seen it yet. Again, the economic burrow, Riddick Goyle, and I'm really glad to see Stephanie show some love there, because I too thought it was I thought as well that it was a great discussion. And the final thing too that I'll bring up tonight before we go off the air is the article that was posted today by Ryan on the AppliedMMT. This is part of the free sub, or if you just give us your email, you get on the reading list here. And Ryan did a great job kind of explaining what's happening with the gold run here and what's taking place and the implication of the recent run up in gold. So if you're not on that list, head on over to AppliedMMT.com, and right on the front page you can drop your email in there and read that. And I don't even think you have to have an account. You can just read it for free. But I thought it was a great post as well. So by all means, jump on over there and give it a look. So that is pretty much what we had for tonight. And thank you everyone for joining. I don't think I have too much, and seeing no other questions, I think we can call it a stream. I'll probably be back Wednesday. So that is a game plan. The game plan is a Monday, Wednesday, Friday stream. And obviously, if things come up, we'll skip. With usually the Monday stream is I try to have this as the flagship, flagship stream. All right, that is what I have for tonight, chat. So thanks for everyone tuning in, and before you check out, hit that like button. It would be much appreciated. But otherwise, have a good night, everyone. A good trading. Talk to you next time. Bye-bye.